Hello and greetings to my beloved lecturer, Dr. Jalida. And first and foremost, let me introduce myself. My name is Muhammad Azhar Farhan bin Muhammad Azhar from KBA 2425A. And in this video, I'll be presenting my research proposal on the factors that could affect the firm profitability in the banking sector. First, let's take a look into the background of the study. There's a heated debate about which element in the capital adequacy ratio, sales growth, leverage, or firm size is the primary cause of financial profitability. In terms of earnings and equity, market capitalization, the sector of the economy leads the globe. In terms of growth, it is a vital aspect of business success, and it has also become a source of evolution and progress for a country's economy. The degree of profitability is a critical component of banks that contributes in the smoothness of operation in economic activity. Profitability at the bank level is regarded as a condition for competitiveness and the long-term viability of a financial organization. Profitability is also one of the main priorities of this research. It may be defined as the firm's earnings or the stability of its cash inflows. A variety of financial ratios can be used to assess a company's profitability. Profitability may be measured using a variety of approaches, including return on assets or return on equity and also return on sales. Return on asset is a ratio that measures how effective a company utilizes the assets to produce profit. Return on sales, it represents the firm's earnings from each rupee of sales reflects the company's short-term success. Return on equity is a measure of company's ability to profit on the money invested by its shareholders. Moving on to the problem statement, based on data and analysis from tradingeconomics.com, the website quoted that the bank return on assets in Malaysia was requested at 0.88973% in 2020, which is a really small amount of increase. This is due to the COVID-19 pandemic that happened between 2019 to 2022. Since 2018, the performance of the banking sector is based on the return on assets has plummeted over the years up until the research is conducted. With the moratorium announced by the government in 2020 to ease the suffering the people in debt, however, this has led to the increase in loan applicants as now they are lifted from the obligation to pay loans, giving them the opportunity to borrow more money from banks, thus increasing the sales growth of banks even though there is only a slight increase. Size of the sector does not determine the profitability of the banking company. Acquiring a decent amount of profit is necessary in order to preserve long-term business goals and growth. In this matter of question, what would possibly the best mechanism to augment profitability in a financial firm? The main question for researchers is they have yet to recognize and rank the most influential factors that would determine firm profitability between the capital adequacy ratio, leverage, firm size, and sales growth. Now let's move on to the literature review. The first one is we are going to talk about the return on assets. Profitability ratios are a type of financial indicator that is used to evaluate a company's capability to create earnings compared to its sales, operational costs, balance sheet assets, or shareholders' equity over time. Researchers use data from a single point in time. A higher number compared to a competitor's ratio or the same ratio from a prior period shows that the firm is functioning well for most profitability ratios. The profitability ratios are most relevant when compared to similar firms, the company's own history, or the industry average ratios. Profitability ratios include several, which are the measurements of profit margin, return on assets, and return on equity. And in our case, we have used return on assets as our dependent variable. Second, let's move on to growth. Many researchers have explored growth of business. According to the majority of the researchers, each enterprise must begin, then grow while facing various challenges and crises, and finally mature and then decline. There are numerous factors that contribute to the success of a business. There are also numerous precursors that will allow an enterprise to progress from one stage to the next one. Some of the factors influencing an enterprise's growth is its history, the characteristics of the entrepreneur, various agencies such as market, government, and so on, and lastly, the geography. Next, we are going to talk about firm size. Firm size is a scale that may be used to determine the size of a firm in a variety of ways, including total assets, lot size, stock market value, and others. Essentially, the company's size is simply split into three groups based on total assets, namely major firms, media companies, and small enterprises. And next, we are going to talk about the capital adequacy ratio. A bank may be able to expand the types of successful investment this could make with a higher capital adequacy ratio. The capital adequacy ratio, also known as capital adequacy ratio (CAR), measures the bank's capacity to fund its operating activities as well as its capacity to cover the risk of loss resulting from its operations. A bank's probability may increase if it has enough capital. This implies that the bank will be more profitable as more money is invested. And last but not least is leverage. Leverage is the birthchild from using credited capital as source of funding when investing with the goal of expanding a company's asset based on generated gains on risk capital. Leverage can also be defined as the use of external or borrowed money invested in the business to finance its assets. Most business has two kinds of investment, which is internal and external investment. Internal investment stands from equity and preference shares, carrying no fixed charges. Meanwhile, external investment consists of debt and it's borrowed money, which can be in a version of loan or debentures. The interest rate on debt is fixed and notwithstanding the company's rate of return on asset. And now let's talk about the research hypothesis. First, we have growth. Prior profit rates had a positive impact on current growth rates, but current and prior growth rates had negative impact on current profit rates in the restaurant industry, according to this study. The study and empirical findings contribute to the understanding that profitability helps firms survive and grow, thereby helping reduce the economic rivalry. Growth has a negative impact on survival but a strong effect on profitability, implying that improving operations to increase profitability or reduce uncertainty may be rewarding but risky strategy. Next, we have firm size. There was a positive relationship between firm size and profitability of financial sector in Malaysia. The majority of the studies measuring the influence of firm size on profitability have found results with positive direction between firm size and profitability. Next, we have the capital adequacy ratio. According to Asri and Surajaya, third parties deposit significantly and favorably affect profitability. And other authors also put forward a research hypothesis about local and international banks in Nigeria. The outcome suggests that authors accept the null hypothesis and reject the alternative hypothesis at a significance level of 0.05. Therefore, it may be inferred that there is no meaningful connection between Nigerian domestic banks' profitability and their capital adequacy. The findings of another article also showed that the capital adequacy has a favorable effect on bank profitability, which is consistent with both the theoretical prediction and the conclusion of other writers. Last but not least, we have leverage. Companies with massive amounts of debt have a greater risk of having lower return on assets, who must settle in terms of interest and principal payment upon maturity of debt. And insignificantly, the return on asset is also impacted by the firm's leverage. A firm's profitability and leverage are negatively related to each other, which means the leverage and firm profitability is insignificant. And now, moving on to regression analysis. First, let's start with sales growth. Based on the regression analysis, the p-value for sales growth is found to be positively significant at significant level of p bigger than p is larger than 0.1. And next is firm size. The p-value of the firm size is found to be negatively insignificant and at significant level of p larger than 0.1. Third, we have capital adequacy ratio. The p-value for this variable is found to be positively significant where the p-value is equal to 0.0274. And last but not least, we have leverage. The p-value for leverage has resulted to insignificant to the return on asset based on the regression table where the p-value is equal to 0.2885. And now we have come to the conclusion and implications of the study. In conclusion, the aim of this study is to examine the variables affecting Malaysia's banking sector's profitability in the years of 2019 to 2021. On the other hand, consider the size of the data gathered from this study, which consists of 11 samples from Malaysia's banking industry. Both the regression method and the descriptive statistics were used in the study. This analysis found out that of the four factors, the growth capital adequacy ratio, which is the first two, has a substantial impact on the profitability of Malaysia's banking sectors. Leverage and the other two factors, which is business size, have minimal effects on profitability. This demonstrates how the company's capital and level of sales growth in certain industries are related favorably to the profitability up to a point. It may be claimed that capital and sales growth are generally correlated, since if a bank has more capital, its sales growth will also rise. Each bank has a different strategy according to its spare capital. Malaysian banks should set goals for sales growth that can be met with their available resources. Moreover, the researchers advise conducting more research on these subjects, particularly in relation to the banking sector, by incorporating more variables, whether internal or external variables, in order to improve the quality of the study that have already been done, and to identify the causes of more significant factors that affect banking company profits.